In this video, you're going to learn everything about market liquidity, supply and demand zones, and how you can use it and make more than 1,000 pips in the market. So stick to the end. Market liquidity is also known as money flow. They are created by orders placed in the market by traders. There are certain times liquidity is low, and there are certain times they are high, especially in the Asian market, right? So liquidity is actually low. You will see small ticks in the market during the London time, or when the London section aligns with the New York section, you see a high volume. So usually the greatest or the greatest traders or trading hub in the world is usually the New York and the London times. All right. So there are a lot of traders that have high volume of liquidity. So they pour money into the system. So you will now see the market moving even faster, right? So there will be more ticks in the market and more sweeps. All right. So then you now know that there is a high liquidity. So it's actually the money flow where the money is where liquidity is. And now the interplay between buyers and sellers creates what is called demand and supply zones. So when there are more supplies, you will see a fall in price, and now that will create a supply zone, and buyers will buy at the lowest price, so the price will fall. And when there is, a lot of buyers, when there's a lot of buyers, you will see a demand zone, and when demand is high, the price tend to increase. So looking at this illustration, you will see that the first is the bullish trend causing price to push up. The buyers are more in the market, so this event causes the few sellers to increase their prices because demand is high and they make a lot of profit. And this pushes it all to, new highs, higher highs. All right, here you will now see that the supply is very high. There are a lot of sellers in the market, and they begin to sell their prices, the commodities at a very low price, because the buyers now are looking for the best price, to buy. All right, so now they begin to reduce their price so that they can actually leave the market already. So it causes a lot of lower lows and making the price to go down. So liquidity shows you where the money is flowing, and sometimes the market moves sideways. All right, and all of that. But many traders make a lot of profit using the trend, either the bullish trend or the bearish trend. So I'm going to show you how this one works exactly in the market. But before we go into that, I want to show you this. How does liquidity or how does market fluctuate? So looking at this now, assuming, let's say, Mr. A or trader A enters the market at 5, all right? So he intends to sell his product. He purchases this commodity at at maybe $5. Okay, he purchases it at $5 and he wants to sell it at $6.5. So that is that. So when he buys this product, he begins to inquire in the market who is willing to buy this product at 6.5. And if someone is willing to buy it at 6.0, he has no option than to sell it. That's where you have to do your calculation right now, because there are sometimes you may want to sell, who knows, maybe at 7.0 and nobody's willing to buy. All right. And you could see 6.0. So it depends on how you make your good analysis in what I'm going to show you right now. So, and then what if he gets into the market and you see someone willing to buy at 4.0? He's going to make a loss. So now you will see that if you wait and there is no, alternative, you see that the order flow will begin to go down. So now he's going to make a bearish candle, right? And then that is if that is the case. And maybe he's about to make that deal and someone pops in the market and wants to buy at 5.5, and then you see that the candle will shift back to the bullish angle, taking it up now. And then if someone gets to make a higher offer, 6.5, you can sell at that. or maybe 6.0 as the case may be. So this is why you see the candle move up and down, because traders are filling orders. They're filling orders, filling buy limit orders, sell limit orders, filling buy stops and sell stops at the swing highs and the swing lows of trends. All right. So that is how it works. So right now I'm going to show you how this thing works in the market. And another good thing I want to show you is how to use trailing stops to actually secure your profit, especially when you are trailing or making that sniper entry, the SMC sniper entry. You want to make so much, but at the same time, you're also trying to protect your profit and make sure that you maximize your profit and reduce your losses. So we're going to show this right now in the market. All right, we're in the gold market right now. So at point A, C, E, we see that there are swing highs here and this order flow. So this order flow is actually bearish. Looking at this, this is a beautiful bearish trend. So let's make our analysis on how this trend moved and how we can maximize profit in this trend. Okay, so looking at this now, we have our swing low BD. So we are drawing, okay, drawing a trend line here. Okay, so this should be what we're drawing. Okay, so all right, cutting across this, and then we're repeating the same thing at the swing highs at A, T, E. Okay, so we're setting it here right now. So we are assuming we entered this market at A. Okay, so this market moved and got to A. There was a resistance, okay, from the initial swing, swing low, then move down to a swing high, a new swing high right now. So it starts up or creates a supply zone, and the sellers were much more in this um, point in the market, right? So the sellers have to push the price down. What really happened? Because the buyers were few, the buyers began to buy at the lowest price. So sellers begin to reduce their price so they can leave the market already. And this is what happened. And it moved it to B. And this B, the price is low and the influx of buyers shows a low price, and the buyers would always want to get things at a low price. So it began to push the demand. Now the sellers are leaving, and the few sellers begin to push the price even down. All right, the fluctuation happened here, getting as this C swing high, and then it moved and then it moved C, and then even downwards to D. All right, breaking the structure at D. All right, so the initial low was broken, this low getting to a lower low. All right, and then looking at this, you are seeing a confirmation at D that definitely, if it cuts across this the swing high again, we are looking for a bearish liquidity sweeps at E for us to make a purchase. So in this whole trade, or in this whole analysis rather, we are making our purchase at E. So analyzing A, B, C, D, we are making a purchase at E. So right now, if we make we'll go short at this point, all right? We'll go short at this point, okay? And then we are seeing our, this is our stop loss, and the stop loss is here, all right? And then remember that this is the London section, all right? So looking at this, okay, we are seeing a strong and then this will be our take profit rather. All right, this will be our take profit rather. So if you make your stop loss here, you need to make it, because now you're using a trading stop, so you need to make sure that you are having a very extensive take profit. So now looking at this, our take profit is more than 500 pips, and then the stop loss is about 100 pips, so it's 5:1. So our trailing stop will be first of all, you need to make sure it must trail an appreciable, limit to the current price. All right. So assuming the current price moves to 300, all right. So let's say 300 pips, it should trail. Our trail should be 300. It should be 100 away, 100 pips away from the current price, right? So when is this point? All right, when is this point? It should trail at 100 to this point. All right, so this will be our new stop loss. Right, this is what will happen. This will be our new stop loss. And when it trails again, even down, the stop loss will follow suit. All right, so it will be 100 pips away from the current price. 100 pips away from it. It gives it a lot of time to breathe. So looking at this market, we hit our take profit and we made a huge profit here. All right, so now at point, let's call this point F. So at point F, we took another, okay, we took another order. We went long now. We went long, all right, and then this is our take profit, stop loss rather. We set our stop loss here, and now we repeated the same stuff here, believing that definitely it will get to this point. If it reverses, then we made a loss, all right? Fine and good. If it reverses back to point F, we made a loss. But remember that we made a profit already 5 points. And then even if we make a loss here, you're going to get, you're still going to be at 4, right? 4 points, all right? And that's that. So you are still in profit for the whole day. So looking at this, um, pushing this here from the open price here to the take profit. All right, you are seeing the same stuff here, and then this too, you're seeing the same, right here. Okay, roughly the same. Okay, so at the end of the day, our trailing stop will, trail 100 pips away from the price. So this is how we are going to make this thing work. All right. So see what we're going to do now. We're going to show you a practical way on how we did this. So watch out and see how it worked. This trade now, we're going to show you a practical way on how we are going to make the trailing stop work. So look at now, watch how it worked. So looking at this now, our take profit is our stop loss rather is 100 pips, and our take profit is 250, right? So our trailing stop is 100. So our minimum, profit, or rather um, our minimum attainable profit will be, let's say, 1,500 pips. Sorry, 150 pips rather, 150 pips. Okay, so when it gets at 150 pips, it's going to trail, by 100 away from the current price. So when it gets to somewhere here, a trailing stop should take action, all right? Should put into play, covering us from other losses. So this is what is going to happen here. So moving there, like if it gets to the swing low, from the swing high to the swing low, all right, you see our trailing stop should move. Right now, you're seeing what I just said, okay? So now, even if this market reverses, we are still in profit, okay? So this is how to use the trailing stop in um, Unism, or in, okay, like you moved again, okay? So now this is how to use a trailing stop, especially with a good entry market structure. You see now that the trailing stop moved here now, and that is it. So you see that it made an amazing profit. So to practically use this in your trade, all you have to do is this. You get to this, all right? Um, you set your take profit. So our take profit will be, let's make it 300, all right, or 400 pips. And then your stop loss will be, um, let's say, okay, 100 pips. And then for the trailing stop, you have to turn it on, right? And then you set it to 100 pips. So it should be 100 pips away from the current price, right? So what's the minimum profit in pips now? So let's make it 200. So when it makes 200 pips, you should trail 100, all right? Just as you saw in the illustration below. So if you want this tool, or if you want this software, it is on the link below. You can check our website and get it for yourself and know how to use it. Every user manual or the instructions on how to use it is all there. This is how to analyze the market using the knowledge of market liquidity, the supply and demand zone in a very short and precise way, okay? If you learned anything in this video, please like and subscribe. All right, I would like to hear your thoughts. You can share it in the comment box. All right, and for more of our videos, please you will subscribe so you'll be the first to see it. All right, so bye for now.